This video isn't about money, but if you hold even a single XRP and you're finding this content valuable, make sure you subscribe and turn on notifications. It genuinely helps us deliver faster and more accurate crypto analysis. And what we're about to cover might be the most important thing you watch this week. That's not hype, it's context. Because while everyone's attention is locked on Bitcoin price swings and Ethereum network fees, something far more significant is unfolding quietly beneath the surface of global finance. It doesn't dominate social media. It doesn't depend on viral moments. It doesn't chase hype cycles. It's called XRP. And it was never designed to impress day traders. XRP was built to work. That's the single most important thing most people miss. Bitcoin is a groundbreaking store of value. Ethereum redefined what programmable money could be. But XRP was architected for an entirely different purpose. Not as a speculative vehicle, not as a digital collectible. XRP was engineered as financial infrastructure, the kind global finance actually demands, the kind that banks, institutions, and governments can plug into without dismantling the existing system. That's why the team behind Ripple looks nothing like your average crypto startup. These aren't developers chasing viral moments. They're professionals who operate more like financial engineers and compliance experts. Many come directly from Wall Street, top-tier academic institutions, and legacy banking. They understand regulation. They understand how capital moves at scale. And most critically, they know how to build systems that last. Ripple's strategy was never to overthrow the financial system overnight. It was to upgrade it, methodically, piece by piece, from the inside out. Here's where positioning becomes more important than timing. Public markets are still pricing XRP as if it's an early-stage altcoin. Meanwhile, private institutions are valuing it based on real utility, transaction flow, and long-term integration potential. This gap between public perception and private conviction is where the real opportunity lives. Markets don't move when everyone agrees. They move when reality finally catches up to what insiders already know. Ripple has been clear about what's coming next. The next wave of crypto isn't built on memes or speculation. It's built on tokenized real-world assets, stablecoins replacing traditional dollar transfers, treasury bills settling on-chain, stocks and bonds moving digitally across borders in seconds. Consider how value moves today. Cross-border payments are slow, expensive, and fragmented. Banks depend on aging correspondent banking networks that can take days to settle a transaction and extract enormous fees along the way. Enormous pools of capital sit locked in Nostro and Vostro accounts globally, idle, waiting, just so institutions can settle transactions later. It's a system that's inefficient almost by design. XRP addresses that inefficiency directly. XRP functions as a bridge asset. It allows value to transfer between two different currencies in seconds at a cost of fractions of a cent. No pre-funded accounts, no multi-day settlement windows, no chain of intermediaries each taking a cut. Just on-demand liquidity, instantly. That's why XRP isn't just another token. It's a neutral connector. A financial rail that doesn't belong to any single country or central bank, yet has the capacity to link all of them. Here's where things start to get genuinely interesting. While retail investors debate price targets online, major financial players are moving quietly. As of early 2025, more than a dozen regulated financial institutions, collectively managing well over $200 billion in assets, have formally filed applications with the SEC to launch an XRP-based ETF. This isn't speculation or rumor. These are regulated firms asking regulators for direct institutional access to XRP. We've already seen what happens when that door opens. When Bitcoin's spot ETF was approved in January 2024, institutions didn't ease their way in. They came in a flood. Billions of dollars flowed into Bitcoin in a matter of weeks. Liquidity conditions changed fundamentally. The narrative shifted permanently, from fringe experiment to institutional-grade asset. Now ask yourself an honest question. What happens if XRP gets that same green light? Because unlike Bitcoin, XRP already has a clearly defined operational use case tied directly to global payment flows. It's not waiting to become useful. It's already being used. Banks, Payment providers and fintech firms are actively integrating Ripple's technology into live financial systems. And this isn't a theoretical roadmap. Ripple currently holds over 60 regulatory licenses across jurisdictions worldwide. They spent years engaging with regulators rather than evading them. They chose compliance over confrontation. That's why when the SEC lawsuit was resolved in Ripple's favor, the company didn't just survive. It emerged with stronger legal standing and greater institutional credibility than ever before. That legal clarity changed the entire landscape. For years, the regulatory cloud kept institutional capital on the sidelines. Compliance departments couldn't engage. Funds couldn't model XRP into long-term strategies. That chapter is now closed, and with it, a new phase begins. One of the most underappreciated developments right now is Ripple's stablecoin, RLUSD. It launched without fanfare. No massive marketing push, no celebrity endorsements. And yet within roughly 6 months of launch, RLUSD grew from zero to over 500 million in total market capitalization. That trajectory isn't organic retail enthusiasm. That's institutional adoption. RLUSD moved from being the 36th largest stablecoin to the 17th in record time, and is now among the fastest growing stablecoins in the world. Think about what that means. Ripple is now directly competing in the stablecoin space with some of the largest financial entities on the planet. That alone should demand serious attention. But what matters most isn't RLUSD's growth in isolation. It's how RLUSD interacts with XRP. On the XRP ledger, XRP is the native asset. When assets are exchanged, XRP frequently serves as the bridge through a mechanism called auto-bridging. Every time RLUSD is traded on the XRP ledger, XRP facilitates that transaction. And each transaction permanently destroys a small amount of XRP. This is where supply dynamics become critical. Unlike many crypto assets with inflationary emission schedules, XRP's circulating supply decreases over time as usage increases. More transactions mean more burns. More burns mean reduced supply. And reduced supply combined with growing institutional demand creates structural upward pressure on price. Not driven by sentiment, but by mechanics. Here's the part most people aren't factoring in yet. As of now, approximately 83% of RLUSD activity still happens on Ethereum, not the XRP ledger. The reason is familiarity. Developers and institutions default to what they know, but Ethereum is slower and considerably more expensive. As RLUSD scales, cost efficiency will matter more. Settlement speed will matter more. And when that volume begins migrating to the XRP ledger, the burn rate for XRP accelerates meaningfully. That's the hidden lever. XRP doesn't need hype-driven demand to appreciate. It needs usage. And usage is growing, quietly, systematically, and across borders. Meanwhile, broader market conditions are setting the stage. Bitcoin continues to draw institutional capital at a significant pace. Multiple analysts have publicly discussed Bitcoin reaching $150,000 to $200,000 or beyond in this cycle. If that plays out, capital historically doesn't stay concentrated in Bitcoin alone. It rotates outward into assets with genuine utility and product-market fit. And those assets tend to outperform during that phase. XRP sits firmly in that category. At current prices, XRP is still being valued like a speculative token when its actual role is closer to financial plumbing. And as any infrastructure investor knows, plumbing doesn't need to be exciting. It needs to be everywhere. The global stablecoin market sits around $250 billion today. Projections suggest this could expand to $1 to $2 trillion over the next several years. That growth won't be distributed evenly. It will concentrate around platforms capable of handling regulatory compliance, transaction scale, and cross-chain interoperability. Ripple has spent years preparing for exactly that environment. RLUSD wasn't rushed to market. It was developed deliberately, integrated directly into Ripple's existing payment infrastructure, and aligned with XRP's bridge role rather than positioned as a competitor to it. That's not coincidence, it's strategy. As stablecoin volume grows, as real-world assets move on-chain, And as institutions demand faster and cheaper settlement, XRP's relevance increases, not because of narrative, but because of necessity. And that's precisely why the ETF matters so much. An XRP ETF isn't simply a price catalyst. It's a signal to the entire financial industry that XRP is acceptable, investable, and appropriate for portfolios designed around global finance exposure. And once that door opens, demand doesn't trickle in. It rushes, especially when the asset is still priced in single digits. As institutional layers accumulate, something else happens mechanically in the background. Wallet addresses grow, transaction volume rises, burn accelerates, supply tightens. Not overnight, but steadily, structurally, and compoundingly. This is how infrastructure assets reprice, slowly at first, then all at once. Most investors are still analyzing XRP with the wrong framework. They compare it to meme coins or even to Bitcoin, asking whether it can 10x or debating decentralization. That framing misses the point entirely. XRP is closer to a financial protocol than a speculative token. Its value derives from how much capital flows through it, not from how many people are talking about it online. Consider Visa as a parallel. Visa doesn't hold your money. It doesn't speculate on anything. It facilitates transactions. And because trillions of dollars move through Visa's network every year, the company itself carries enormous value. XRP is positioning for a comparable role, but on a global currency-agnostic level, without being owned by or tied to any single nation. Right now, trillions of dollars cross borders every single day. Foreign exchange markets alone clear over $7 trillion daily. The vast majority of that activity still depends on infrastructure built decades ago. Slow settlement, high friction, counterparty risk, capital tied up unnecessarily. XRP was built specifically to eliminate that friction. And unlike many crypto projects, Ripple didn't try to build adoption from the grassroots up. They went directly to the institutions, banks, payment networks, central banks, regulators. That approach takes longer. But when it works, it scales faster and lasts far longer. Institutional sentiment is clearly shifting. Projects that were previously dismissed are being reevaluated with fresh eyes. Even former skeptics have acknowledged that Ripple's persistence through legal adversity, continued product development, and expanding regulatory wins have fundamentally changed the risk profile of XRP entirely. Capital follows legitimacy, and XRP now checks every box that institutional capital looks for: clarity, scale, and compliance. It's also worth noting, XRP doesn't need to replace Bitcoin or Ethereum to succeed. It occupies a distinct lane. Bitcoin stores value. Ethereum executes programmable logic. XRP moves value. These roles are complementary, not competitive. In a world where trillions in assets become tokenized, fast and reliable settlement rails become essential infrastructure. Ripple's technology is being built to serve as exactly those rails. This is why governments are warming to digital settlement. This is why institutions are filing for ETFs. This is why Ripple continues expanding its global licensing footprint. And this is why XRP keeps appearing in conversations that actually matter, even when it's absent from the trending topics. The market hasn't fully priced any of this in yet. But markets always catch up to reality eventually. As more RLUSD volume shifts to the XRP ledger, as ETF demand materializes, as transaction volume grows, and as supply continues contracting through burn, the valuation framework for XRP begins to change. It stops being treated as a speculative altcoin. It starts being priced as financial infrastructure. And infrastructure doesn't move in small increments once adoption reaches critical mass. Institutions don't wait for headlines. They don't wait for retail excitement. They move when risk is removed and upside becomes asymmetric. That's the exact environment XRP is entering now. For years, regulatory uncertainty kept trillions of dollars on the sidelines. Not because the technology didn't work, but because compliance teams couldn't engage with it legally. That chapter is now closed. And with clarity comes capital. Supply shock doesn't begin with dramatic price moves. It begins with quiet accumulation. Volume increases without much visible price reaction. Wallets grow, Liquidity thins gradually. Then one day, demand overwhelms available supply, and the repricing happens faster than most people anticipated. XRP's supply dynamics are widely misunderstood. Yes, the total maximum supply looks large, but circulating supply is what drives price. And circulating supply is consistently tightening through burn, long-term custody, and institutional holding. Every transaction on the XRP ledger removes XRP permanently. On a daily chart, it appears negligible, compounded across years of rising transaction volume, especially as stablecoins and tokenized assets accelerate usage. The cumulative effect becomes substantial. And here's the important distinction from Bitcoin in an ETF scenario. Bitcoin's supply is fixed but not decreasing. XRP's effective supply is actively shrinking with increased usage. That creates a dynamic where adoption and scarcity reinforce each other simultaneously. At the same time, Ripple's global presence continues expanding. More regulatory licenses, more payment corridors, more institutional integrations, more governments exploring digital settlement infrastructure. This isn't a theoretical pipeline, it's operational adoption happening right now. This is also why XRP doesn't require retail enthusiasm to succeed. Retail attention typically arrives after infrastructure is already embedded. By the time mainstream narratives shift, the easiest positioning is already behind you. You've seen this pattern before. Early internet infrastructure companies weren't exciting to the general public. The excitement came years later once the world realized how deeply dependent it had become on systems most people never thought about. Financial rails work the same way. Nobody thinks about how value moves until it stops moving efficiently. That's the problem XRP solves, and that's the opportunity sitting in front of anyone who sees it clearly before the market catches up. If Bitcoin reaches $150,000 this cycle, the total crypto market cap expands meaningfully, and infrastructure assets with real-world utility tend to attract institutional rotation. Under those conditions, XRP at $5 isn't an aggressive call. It's a conservative one, aligned with historical altcoin rotation patterns, current adoption trends, and tightening supply dynamics. If Bitcoin moves toward $250,000, XRP in the $8 to $10 range becomes increasingly reasonable, particularly with a live ETF and continued RLUSD expansion. These aren't moonshot projections. They're scenario-based estimates grounded in usage trajectories, institutional demand, and market structure. And importantly, they don't assume XRP dominates global finance. They assume it becomes one of the primary rails. That's a far lower bar, and still an enormous outcome. Another often overlooked factor, XRP's wallet count now exceeds 6 million and continues growing steadily. Not in hype-driven spikes, but through consistent organic adoption. That's a meaningful signal. It indicates users are holding and actually using XRP, not just flipping it for short-term gains. XRP doesn't need to be the most talked-about asset in crypto to win. It needs to be used, and usage is being driven by institutions. The fact that XRP spent years as an underdog may actually be its greatest structural advantage. It allowed Ripple to build without distraction, to prioritize compliance over clout, to integrate with regulators instead of fighting them, and to develop real-world partnerships while others were chasing narrative cycles. Now that the tide is unmistakably turning, the groundwork laid through that period is beginning to compound. The broader financial system is undergoing a structural transformation. Tokenization of real-world assets is accelerating rapidly. Stablecoins are displacing traditional settlement in an expanding number of corridors. Governments are actively exploring digital currency frameworks. Financial institutions are racing to modernize before the window closes. All of it points in the same direction: faster, cheaper, interoperable value transfer. XRP was built for that world. It's not flashy. It doesn't make promises it can't keep. It offers efficiency, and efficiency always wins over the long run. XRP isn't playing catch-up. It's playing a different game entirely and one on a longer timeline, with a clearer destination. While others chase narratives, Ripple has been embedding itself into the financial infrastructure of the next decade. This is not financial advice. When that reality becomes widely understood, repricing happens quickly. The people who benefit most won't be the ones who buy in at the peak of a hype cycle. They'll be the ones who positioned early, understood the system, and stayed patient while the infrastructure matured around them. That's the real opportunity here. Not a gamble, not a trend, a calculated position in a system designed to move trillions of dollars, more efficiently than anything that came before it. So, when you hear debates about whether XRP is sufficiently decentralized or whether it truly belongs alongside Bitcoin in the same conversation, remember this. Value doesn't flow to what feels good. It flows to what works. XRP works. It works within regulation, it works across borders, it works at scale, and it's working right now. The question was never whether XRP would play a meaningful role in the future of global finance. It already does. The only question is whether you recognize that before or after the market fully prices it in. Because by the time the narrative flips, the easiest gains are already behind you. What remains is utility-driven appreciation. And that favors those who understood the system early